Welcome back everyone to the inaugural video in this new series where I will be chronicling my weekly buys in stock in an account that I'm going to make visible. As always, you know the drill, not financial advice, do your own research, etc. In today's video, I'm going to briefly be going through the account history of the account that is currently operating with this strategy, and basically started a few years ago, show you the steps along the way, and now it's basically been converted to have a regular deposit plus the reinvested dividends, and that is what we are at now. And this stock that I'm going to be talking about this week, I think offers a decent total return prospects, and that's why I bought a little bit of it. Little bit being just based on the dollar cost averaging. Without any further ado, here is the account. It's on Wealthsimple, which I started back in almost to the day in 2019, 6 years ago. And what I did was basically, at the time, it was the only, I believe it was the only free trade brokerage in Canada. And I basically wanted to try it out, and I wanted to see how it worked. And it worked pretty well for about 80% of what you would hope to find in a brokerage. It had the different accounts that you're allowed, and you were able to buy and sell pretty much anything vanilla you could do. It had issues back then. I mean, in terms of it didn't have the full access, still doesn't, and that kind of led me to a few years later. I basically turned it into a source of cash. So I deposited almost 60,000 at the peak, and then over the years I've withdrawn to the point where I've net put in negative 30,000, and this is just what's left over, because basically I'm a pretty goal-oriented person, and at a certain point I didn't really have a goal for this account. I was basically using it as cash to fund either taxes, other investments elsewhere, other accounts, other things, life, and so it just kind of trailed off. And yeah, I mean, you can see some evidence of some past stuff, because I think there's the RRSP had one. I think I put 1 year's worth of stuff in, or part of 1 year, and it basically was too heavy and something that didn't work. The other, the TFSA, I think there's 1 year here or whatever, and then there's the rest is non-registered, noisy birds, and yeah. And then more recently I swapped from a general non-registered to a non-registered margin, and I guess I did that at a very bad time, because that account is down a significant amount since. But what I did after that is I basically decided that I am going to basically dollar cost average into dividend stocks. And what I basically calculated how much dividends I should be making from the account over time, and then I added to that a segment of what I was able to contribute to invest. And so basically I put in $350 every other week, add that to the dividends that I should be getting from the account, which would be about $400 a month, and those $400 a month plus the 700 every other, $350 every other week, so roughly 700, a little bit more every month, and that equals 267 net dollars to invest every week. I'm going to target investing 200. These are exactly what I said. The reoccurring deposit, $350, plus some of the mid-month REIT dividends, plus First National and some other stuff that was a big dividend day on the 15th. But yeah, so that is basically where the account sits. Now for what I bought this week. Now, what I bought this week is Alaris. Alaris is not exactly a company, not exactly a fund, not exactly an asset manager. It's a bit of a misfit. And in the theme of misfit, they basically try to have a stable cash flow by investing in primarily preferred equity from smaller private companies, I should say. And the majority of their portfolio is that, but they also have in more recent years they started adding separately managed, so they manage funds from other asset managers, along with having some common equity as part of the deals they do. And the reason why, the reason why this might fit in a dividend account is because the yield is 7-point-something%. I mean, depends on the day. But the yield, when you're looking at something that high, the first thing you'd be looking at is the payout ratio too high? And that's a valid question. So let's dig in. So while the results have been uneven, especially in the past few years since they've added both common equity and outside managed funds to their portfolio, they have been better recently. And if we look at the average result over the last 5 years, we can see that their return on what is their book value would be on average 15%, which means that if they were trading at book value, which they're not, they're trading at a discount. If they were trading at book value, your expected average return would be 15%. Now, would I expect the market to like an uneven 15%? Perhaps not. So that might be a reason for a discount. The other side of it is, if you want to look at what that 15% return on equity, if you will, would mean, it would mean that at today's book value of about $24, if that's representative of the company, the 15%, it would mean that the $24 would amount to a 38% payout ratio on the 7-point-whatever% dividend yield. Or actually, it's not all dividend, but 7-point-whatever% yield would only be sub 40% payout ratio. So that also would translate to 9% growth at the company level. 9% at the company level, which is closer to 12% at today's market cap because of the discount. So with further opportunity to enhance the growth by buying shares back at a discount to book. So if you put it all together, you get the 7% dividend yield plus the 9 to 12% growth. So that's, deduct even tax or whatever. So it's maybe a 15 to 19% IRR. And if you figure the terminal value, like if it someday gets to book value, you still, if they can earn the 15%, that would be 6% yield and 9% growth, which is pretty acceptable, even if they decide they're going to increase the payout ratio to their target. Still, 15% IRR. this is something that seems like it theoretically should trade above book. I don't know how much above book, because even if you were to say it's on average 15%, the unevenness might be a bit of a reason for discount. So maybe it's 1.3, maybe it's 1.5, but here we're sitting at something like 0.8 times book, book being $24. So, re-rate, potential upside, decent yield weighting, and all that plus more growth than the yield. So altogether, seems like it makes sense for me. Bought a little bit this week, might buy a little bit more, or might buy something else next week. So yeah, this week I bought a few shares and put it in my tracker, move on to the next week. And I'm going to leave it there for today. Questions, comments, concerns are all welcome. And until next time, have a great day.